Welcome to the debate. It is Tuesday, February 10th, 2026. And if you have the stomach to look at your portfolio today, you are likely staring at a sea of red and asking yourself a very expensive, very painful question. Is this the end?
It's a bloodbath out there.
It is. We are watching Bitcoin fighting for its absolute survival at the $60,000 level. I mean, that is a staggering 52% collapse from the euphoric highs of, what was it, $126,000 we saw just 4 months ago in October?
Right.
So the question we're wrestling with today is fundamentally about the driver of this collapse. Is this a structural regime change caused by a hostile Federal Reserve and the death of the four-year cycle, or is this a sentiment-driven panic that's blinding the market to some massive underlying accumulation? I'm the advocate, and I'll be arguing that the net liquidity model has permanently replaced the halving model. The macro environment led by the new Fed regime suggests crypto winter is the only rational outcome.
And I'm the dissenter. And I have to say, I look at the exact same chart, but I see a completely different reality. I believe the market reaction here it's excessive, bordering on hysterical. While the macro picture is undeniably tight, the on-chain data, specifically regarding whale behavior, is flashing a classic contrarian buy signal. I'll be arguing that this whole Warsh hawk narrative is already priced in, and what we're witnessing isn't a death spiral, but a transfer of wealth from the fearful to the strategic.
Okay, let's get into the machinery of this crash, because the pain in the market is palpable. My position is that as of February 2026, we have learned a very hard lesson. For the last decade, the dominant narrative was that Bitcoin is digital gold, right? A hedge against inflation, a sovereign store of value that operates independently of the traditional financial system. But the data staring us in the face today suggests that was, a myth. Bitcoin is, and perhaps always was, a high beta proxy for the M2 money supply.
Whoa. Okay, that's a pretty heavy accusation to lay on an entire asset class with $1 trillion market cap. You're essentially stripping it of its unique properties.
The chart doesn't lie, though, does it? When I say high beta for those listening who maybe don't speak Wall Street, I mean it acts like a technology stock on steroids. It just amplifies the moves of the broader market. When money is cheap, it flies. When money is tight, it dies. We spent the better part of a decade relying on the four-year cycle, the halving, to predict these bull runs. We were promised a super cycle that would last through 2026. And what happened? We hit 126K in October 2025, the liquidity dried up, and instead of a super cycle, we walked straight into a liquidity trap. The Trump pump that carried the market through late 2024 has been completely erased, and why? Because the punch bowl has been taken away.
I think calling it a trap implies a level of permanence and maybe even malice that I'm just not ready to concede. You're looking at the symptom, the price, and calling it the disease.
But look at the mechanism. We are looking at a Federal Reserve balance sheet that has contracted from nearly $9 trillion in the post-pandemic era down to approximately $6.6 trillion today. That is the primary mechanic. It is sucking the oxygen out of the room. You just can't have asset inflation when the central bank is actively destroying money. That isn't an opinion. It's arithmetic.
Okay, I see where you're going. And I'm not ignoring the Fed. $60,000 is a painful drop. But I just don't buy the finality of this liquidity trap thesis. You're focusing entirely on the Fed supply side. The dollar is existing in the system. But you're ignoring the demand side within the asset class itself. While everyone is screaming about the macro outlook, smart money is behaving very, very differently than the panic sellers we're seeing all over X.
Smart money gets liquidated just as easily as retail when they're over-leveraged. History is littered with smart hedge funds that went to zero because they fought the Fed.
But are they leveraged? That's the key distinction. If you look at the bull case data that's sort of hidden under this crash, it's fascinating. I'm talking about whale wallets. These are entities holding more than 1,000 Bitcoin. These aren't day traders on 100x leverage. These are sovereign funds, large family offices, maybe even nation states. And they added 53,000 coins in the first week of February alone. That is roughly $3 billion of buying pressure in a single week. That is not the behavior of investors who believe the asset is going to zero or that the winter is here to stay. They are buying the blood.
Or they're just averaging down into a losing position. Just because you have a lot of money doesn't mean you can't be wrong.
Fair, but combine that with the sentiment. We are looking at a fear and greed index of 7.
A record low.
Exactly. A 7 out of 100. Historically, a reading that low has been a generational buy signal. It indicates that the market is capitulating, perhaps prematurely, before we even see what the Fed actually does in March. The market is vomiting its position because it's scared, not because the asset itself is broken.
But fear can be rational, especially when there's a predator in the room. And this brings us directly to the Warsh Paradox. This isn't just about general Fed policy. This is about a specific regime change. The nomination of Kevin Warsh as the next Federal Reserve Chair is the black swan nobody priced in.
The Warsh Hawk narrative?
It's more than a narrative. It is a fundamental shift in philosophy. We have to be honest about who Kevin Warsh is. He is a known monetary hawk. The market spent all of 2025 pricing in aggressive rate cuts for 2026, assuming the liquidity spigot would just turn back on after the election. But Warsh's reputation and his nomination signals a shift toward quantitative tightening, or QT, and maintaining higher real interest rates. To a guy like Warsh, financial stability is the mandate. He does not care about your crypto portfolio's capital gains. In fact, he likely views asset bubbles as a threat to that stability.
I agree that his reputation is hawkish. I mean, he's certainly not going to be printing money for fun. But we need to separate the man from the market's panic attack about the man.
The reaction is quantifiable, though. Look at the institutional risk models. We aren't just talking about retail traders on Binance anymore. We are talking about the algorithmic models that control the massive spot ETFs like IBIT and FBTC. These models interpret Warsh's nomination as a volatility trigger. They have rationally flipped to risk off. That is why we saw, over $9 billion in liquidations in a single week in early February. It wasn't panic, it was math. It was institutions realizing the cheap money era is being put on ice. When the cost of capital goes up, speculative assets go down. That is a law of financial physics.
Okay, that's a compelling point regarding the algorithms, but you're assuming the algorithms are correct about the future. Have you considered that the market is pricing in a worst-case scenario that hasn't actually happened yet? The March FOMC meeting, Warsh's first real test, is still weeks away. We are reacting to a narrative of Warsh, not the policy of Warsh.
Markets move on forward guidance. They front-run the pain. They don't wait for the press conference. They sell the rumor.
True, but a 42-month low in sentiment because of a nomination? That screams overreaction. You're citing $9 billion in liquidations as proof of a structural shift, but liquidations are often just a flushing of leverage. It cleans the system. It removes the gamblers. It doesn't mean the underlying thesis of the asset is broken. You mentioned that Warsh implies QT, but does the Warsh Hawk narrative justify Bitcoin trading as if the protocol itself has failed? I'd argue that the market is front-running a recession that might not look the way the bears think it will. And the whales adding 53,000 coins suggests they believe this narrative is a bluff, or at least that the policy won't be as draconian as the fear index suggests.
I'm just not convinced by that line of reasoning because it ignores the mechanical reality of net liquidity. It's not just about sentiment or narratives, it's about the plumbing of the financial system. We need to talk about the TGA drain.
The Treasury General Account.
Right, the Treasury General Account. Think of this as the government's checking account at the Fed. It is currently sitting at $909 billion. Now, for our listeners who don't spend their days reading Federal Reserve balance sheets, here's the simplified version. When the Treasury refills this account, taking cash from the banking sector to pay its bills or issue bonds, it effectively vacuums that liquidity out of the market. It's money that is locked away in the Fed's vault rather than circulating in the economy.
It's a temporary hold, though. The government spends that money eventually. It flows back out.
Eventually is too late for the trader holding a leveraged long position today. Eventually is how you go broke. Temporary or not, the correlation is undeniable. Every time net liquidity, which is Fed assets minus liabilities like the TGA, drops, Bitcoin follows within 14 days. It is almost clockwork. We are currently seeing a 42-month low in sentiment precisely because liquidity is flowing out of risk assets and into the safety of the US dollar. And frankly, the dollar has strengthened significantly under this new Fed outlook. When the dollar is strong and the TGA is full, Bitcoin suffocates. It's a mechanical relationship that overrides the scarcity of the halving.
I come at it from a different angle regarding that correlation. You're treating the net liquidity correlation as a law of physics. It's a pattern, certainly, but patterns break. We saw the halving pattern break this cycle, according to your own argument. Why can't the liquidity pattern break too?
Because liquidity is the fuel. You can't drive the car without gas. You can have the best engine in the world, which is the Bitcoin protocol, but if there's no gas in the tank, it doesn't move.
But Bitcoin isn't just a car. It's a distinct asset class with an inelastic supply. By arguing that liquidity is the only thing that matters, you are essentially saying Bitcoin has zero intrinsic value outside of being a sponge for excess dollars. I just don't buy that. Scarcity still matters to the people buying this $60,000 floor. Strategies that suggest moving 30% of exposure to high-yield cash right now, which I know is a popular move in certain circles, might feel safe, but they risk missing the recovery entirely.
Better to miss the first 5% of the recovery than lose the next 20% to a crash. That is just basic risk management. We are in a defensive environment.
But are you missing 5% or are you missing the generational bottom? If you treat Bitcoin purely as a liquidity sponge, you miss the maturation of the asset. The whales accumulating right now aren't looking at the TGA balance for next week. They're looking at the supply cap for the next decade. They see a discount. The cheap money era ending doesn't mean the asset value goes to zero. It means the asset has to stand on its own feet. And at $60,000, with 53,000 coins moving to strong hands, I'd argue it is standing.
Well, let's talk about that $60,000 level. Because from where I sit, it looks less like a floor and more like a trapdoor. As of this week, Bitcoin is barely clinging to that $60,000 to $64,000 range. If we break 60,000, we aren't just drifting lower. We are entering a liquidity vacuum.
A vacuum? Define that for us.
It means there are no buyers. On the charts, there is very little volume support, meaning historical trading activity below this level until you get way, way lower. Technical analysts and the risk models we talked about earlier are eyeing $52,000 as the next major stop. That's a massive drop from here. If the US dollar continues to strengthen, which it should under Warsh's guidance, capital will continue to flee risk assets for safety. The $60,000 support is psychological, people like round numbers, but the $52,000 target is structural, based on where money actually changed hands in the past.
That's a valid technical point, but I would frame the volume argument differently. You see a fragile ledge. I see an accumulation zone. You call it a liquidity vacuum. I call it a transfer of ownership. When we talk about volume support, we are often looking at past trading activity. But look at the activity now. The fact that we are churning here at 60K implies a battle is taking place.
A battle the bulls are losing. Look at the daily candles. Every bounce gets sold into.
Are they losing or are the weak hands finally exiting? The Trump pump tourists are gone. The people who thought the halving was a free lottery ticket, they're gone. So who is left? The entities with the capital to buy 1,000 Bitcoin at a time. The transition from speculators to long-term holders is painful, yes. It looks like a crash, but that is how bottoms are formed. The argument that capital is fleeing is only half true. Capital is fleeing risk, yes, but for a growing cohort of global investors, Bitcoin at these levels is the flight to safety relative to a fiat system that's being manipulated by central bankers.
But that manipulation is exactly why we are down. The Fed is manipulating the money supply down to fight inflation and stabilize the dollar. That's my whole point. You can't fight the Fed. As the old saying goes, don't fight the Fed. And right now, the Fed is telling you to sell.
And my point is that the market has over-extrapolated that manipulation. If the fear and greed index is at 7, the market is pricing in Armageddon. It's pricing in a complete systemic failure of the crypto markets. If Warsh comes out in March and is even slightly less hawkish than the nightmare scenario, if he just holds rates steady instead of hiking, or if he signals that the balance sheet runoff will slow down, the repricing to the upside will be violent. The market is positioned for a funeral, but the patient is still breathing.
I suppose that's where our fundamental disconnect lies. You believe the patient, Bitcoin, is healthy but misunderstood. I believe the patient was on life support provided by the Fed, and the plug has just been pulled. The net liquidity model suggests that without that constant injection of cash, the price simply cannot sustain these levels. It's gravity.
Gravity implies it has to fall. I'd argue Bitcoin is more like a pressurized coiled spring. The lower you push it with artificial fear, the harder it snaps back when the pressure releases.
That's a nice image, but I prefer to look at the cold, hard math. So let's bring this to a close, because we clearly have two very different views on the immediate future. From my perspective, the evidence is overwhelming. We have a new Fed chair who prioritizes stability over asset prices. We have a contracting balance sheet. We have a TGA draining liquidity. Until the Feds, specifically under Warsh, reverses course on the balance sheet, crypto winter is the dominant reality. Caution is the only logical strategy when liquidity is absent. I stand by the move to shift exposure into high-yield cash and short-term treasuries. I'd rather wait for confirmation than try to catch a falling knife.
And I maintain that extreme fear, evidenced by an index of 7, coupled with heavy whale accumulation, often marks a generational bottom, regardless of who sits in the Fed chair. The Warsh hawk narrative is priced in. The sellers have sold. What remains is value. I believe that while the macro is tough, the asset is resilient. The risk-reward ratio here favors the bold, not the timid.
It is fascinating to see how we've moved from the halving era to the net liquidity era. The rules have definitely changed.
They have, but the game remains the same. Buying value when others are fearful.
Well, we can agree on one thing. The upcoming March FOMC meeting will be the decisive moment. That is when we find out if the Warsh Paradox is confirmed or invalidated.
Absolutely. That meeting is the pivot point for the entire year.
Thank you for listening to the debate. We hope this discussion has helped you clarify your own position.
Indeed. Are you watching a liquidity trap or a liquidity opportunity?
See you next time.